Friday closed with Australian dollar to US dollar at 0.6899, exactly on the 200-day moving average, while every headline screamed that Australian inflation is going to peak lower than the Treasury expected. That looks like a clean bearish signal. But here's the trap. The entire retail crowd and half the short-term funds are already short, and Monday opens with a liquidity vacuum right above a multi-week floor. This week has one danger zone and one 3 to 5 day opportunity. I'll show you both right now. On your screen right now, you're seeing 0.6837, the line that defines your week, 2 Monday scalps plus 1 swing. Don't move. Stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days. Here is my instant weekly verdict. The 3 to 5 day structural bias is bearish. Trend is fading from a failed rally, and we are now in a strong sell alignment across daily, 4-hour, and 1-hour timeframes. The single invalidation level that flips the weekly bias is 0.6966. A daily close above 0.6966 and suddenly the bearish structure cracks, and we start talking about a mean reversion back towards 0.7060. But until that happens, the default path is down, targeting 0.6837 first, and a break below that resets the monthly structure completely. Write this number down, 0.6837. If this level breaks this week, the whole monthly structure resets, and we are looking at a leg towards 0.6700 very fast. Now, here's the micro insight about herd positioning. Coming into this week, speculative futures. Positioning is net short but not yet at extreme levels. Meanwhile, the options market shows a fat put wall at 0.6850. That means early Monday, if we get a small bounce, it's short-term pain for late shorts who chased Friday's close. The institutions will likely engineer a stop run above the weekly pivot before the real selling resumes. That liquidity grab is exactly what my second Monday scalp targets. Let's walk the charts from the weekly down to the 60-minute, because the story of the next 5 days is written in the moving averages. On the daily, the MA20 sits at 0.7013, the MA50 at 0.7066, the MA100 at 0.7020, and the MA200 at 0.6895. Price is now trading below all the major daily moving averages, and the 200-day MA is acting as a magnet. We closed right on it. The alignment is textbook bearish. The shorter-term averages are cascading lower, the MA5 at 0.6921 and MA10 at 0.6958 are sloping down hard. That tells you momentum is accelerating to the downside. The ADX on the daily reads 61.22, which is an exceptionally strong trend reading. In a trending market, the ADX above 40 signals that pullbacks are selling opportunities, not reversals. The CCI is deeply negative at -167, confirming extreme downside velocity, but also warning that conditions are temporarily stretched. Now here's what most traders will miss until Wednesday. On the weekly time frame, I'm watching a hidden divergence forming on the MACD. The weekly MACD histogram is at -0.006 and still declining, but the signal line is starting to flatten at extremely low levels. Meanwhile, the weekly RSI on a multi-week scale is hovering near 26. That's deep in oversold territory, a zone that in the past 2 years has almost always produced a violent 2 to 3 day squeeze before the trend resumed. But the weekly ADX is also rising, meaning the downside trend still has structural power. So the hidden divergence is telling me that early this week we could see a false breakout below a key level that sucks in breakout sellers, then reverses sharply for 1 or 2 sessions. That level, I believe, is 0.6837. If we pierce 0.6837 early in the week without a daily close below it, that will be the trap, the liquidity grab on the short side. That's exactly why my Monday liquidity grab play is set up to catch that exact stop run. On the 4-hour chart, the picture is even cleaner. The 4-hour MA20 is at 0.6920 and acting as dynamic resistance. The 4-hour MACD is trending lower with no bullish cross in sight. The 4-hour support rests at 0.6861 and 0.6837. The 60-minute chart shows that Friday's session ended with a series of lower highs, respecting the 0.6904 weekly pivot point as resistance. So for Monday morning, the Asian session range will be critical. A break below Friday's low at 0.6880 will trigger a flush towards 0.6861, and a break below that opens the 0.6837 trapdoor. Conversely, if the price reclaims 0.6904 in the first 2 hours, the short-term momentum flips to a dead cat bounce targeting 0.6923. The first real resistance. That's the scalp zone for strategy 1. Cross-asset linkage is screaming at us right now. Australian dollar to US dollar is the Asia proxy, the risk barometer. When we look at S&P 500 futures struggling below their own gamma flip levels, and iron ore futures rolling over, the Aussie dollar gets hit twice, first from the commodity channel, second from the risk-off equity flow. And with US NFP this Friday, the dollar is on a front foot yield bid, making AUD the weaker side of the dollar killers. The bond spread between Aussie 10-year and US 10-year is narrowing again, which historically leads Australian dollar to US dollar lower over a 3 to 5 day window. So the macro and technical are in violent agreement, retention bridge right here. The next signal changes the whole week. Once you see how the weekly MACD and daily ADX are interacting with Friday's NFP, the trade becomes mechanical. Keep watching. The weekend news set the table. Australia's Treasurer came out and said inflation is expected to peak below prior forecasts. That immediately priced out any residual RBA hawkishness. The market now sees no further rate hikes, and that's a yield disadvantage versus a US that is still holding firm on higher for longer. It's a dovish AUD shock, and the market sold it, but now the question is whether it's fully priced. Judging from option skews, there's still room for further downside repricing. Now the week's calendar builds a narrative web that peaks on Friday, but has 2 other danger zones. Tuesday we have the EZ flash CPI. That matters for overall dollar strength because if European inflation surprises lower, euro weakness pushes the DXY higher, adding indirect pressure to Australian dollar to US dollar. Wednesday we get US ISM manufacturing PMI. That's the first real fuse for the dollar. If ISM beats, the dollar surges and the Asia proxy gets hit immediately. If ISM misses, we might see a temporary relief rally, but it'll be sold into ahead of NFP. Then Friday, the monster. US non-farm payrolls. That is the bomb. The current whisper number is for a slightly softer print, but average hourly earnings will be the real driver. If wages stay hot, the dollar rips higher and Australian dollar to US dollar very likely breaks 0.6837 during the Friday session. So my 3 to 5 day directional lean is bearish, targeting a Friday close below 0.6850. The exact event that would invalidate the weekly bearish lean is a daily close above 0.6966, but also, if NFP misses badly and wage growth collapses, then the whole dollar bid unwinds, and we could see a short covering rally through that level. Here's your second interaction trigger. Do you think Australian dollar to US dollar closes Friday above or below 0.6861? Comment above or below right now. I'm tracking consensus for the week, and this tells me where the herd's bias really sits. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching, because I'm now giving you 2 Monday scalps and the swing trade that can carry you into Friday's fireworks. Strategy 1, the Monday. Opening scalp, scalping, high probability. This is a fast snipe, designed for the first 1 to 3 hours of Monday session. Here's the trigger. If during the London Open or early New York cross, price retests the 0.6910 area, just below the MA5 resistance and just under the weekly pivot, and a 5-minute candle closes below 0.6908, you execute a short. The entry is 0.6908. The stop loss goes exactly at 0.6924, 1 pip above the R1 resistance at 0.6923 and Friday's spike high. This gives the trade room to breathe but keeps the risk tight. Take profit 1 is set at 0.6890. A clean 18 pip snipe that targets the first level of support near the 200-day MA. That's a risk reward of over 1 minute and 1.5 seconds. What instantly voids this Monday scalp? If a 5-minute candle closes above 0.6923 with bullish volume, the short is off. No second chances. You step aside and wait for strategy 2, the Monday opening scalp entry, 0.6908, 5M bearish close below 0.6910, stop loss, 0.6924 take profit 1, 0.6890 risk, reward, (1:1.8 R invalidation, void if 5M candle closes above 0.6923, strategy 2. The Monday liquidity grab, scalping, counter noise. Now this one is counterintuitive. It's based on the trap I told you about. If early Monday we see a false breakdown below Friday's low, let's say the Asian session pushes price to 0.6865, just below the S2 support of 0.6861, and then price snaps back with a 5-minute bullish engulfing candle closing back above 0.6870, that's the signal. You enter long at 0.6875. The stop loss is placed at 0.6859, just below the wick of the fakeout, protecting against a real breakdown. Take profit 1 is the weekly pivot at 0.6904. That's a 29 pip target with a 16 pip stop, giving you a nearly 1:2 risk reward. This play requires aggressive execution because the snapback happens fast. You need your order ready. If the price instead continues to bleed lower with no swift reclaim of 0.6870, you do not take the trade. This is only for the fakeout, stop hunt reversal, the Monday liquidity GRAB entry, 0.6875, 5M bullish reclaim after sweeping below 0.6861, stop loss, 0.6859 take profit 1, 0.6904 risk, reward, (1:1.8 R invalidation, void if price fails to reclaim 0.6870 within 2 candles. Here's your interaction cliff. Are you scalping Monday or swinging the week? Comment scalp or swing. Let's see who's built for this market. Strategy 3, the 3 to 5 day swing. This is the week's core trade. The bias is bearish, and we want to align with the daily and weekly trend to hold for multiple sessions. The trigger is a daily close below the 200-day moving average, which currently sits at 0.6895. Friday we closed at 0.6899, right on it. So if Monday's daily candle closes below 0.6895, that confirms the breakdown and activates the swing short. You then enter on Tuesday's open at whatever price is available, likely around 0.6885. I'll give you the entry as a limit order at 0.6888 just to be precise. The stop loss must be placed outside the weekly structural level that would flip the bias. That's above 0.6966. I want to use a stop at 0.6960, which sits below that weekly resistance but clear of a normal counter squeeze. That's a 72 pip stop. Take profit 1, the conservative midweek target, is 0.6840, just below the S1 confluence. That's a 48 pip gain, roughly 1 minute, and 0.67 seconds risk reward. But the real payoff is take profit 2, 0.6780, a stretch target near the next monthly support, yielding a 108 pip move, which gives a risk reward of about 1 minute and 1.5 seconds on the total swing, but I typically manage it with a trailing stop. Once price reaches halfway to TP1, so around 0.6864, move the stop to break even. Then if we hit 0.6840, trail the stop to 0.6860 to lock in. The invalidation for the entire weekly outlook, a daily close above 0.6940. If that happens, the swing is off, and the bearish thesis is delayed. Given the NFP event on Friday, position sizing must be smaller than usual for 3 to 5 days. The NG entry, 0.6888, Tuesday open, following Monday daily close below 0.6895, stop loss, 0.6960 take profit 1, 0.6840 take profit 2, 0.6780 risk, reward, (1:1.5 R to TP2 invalidation, Void if daily close above 0.6940, never risk more than 1 to 2% of your account on any single trade. And this week, holding through Friday's NFP means you either tighten your stop dramatically or reduce your size by at least half on the swing. Stops are non-negotiable, especially on a swing that runs into a high-impact data bomb. The 0.6960 stop on the swing might seem wide, but it's placed for structure, not for comfort. If you can't afford that stop distance, don't take the trade. This is how you survive to trade the next big weekly move. If I had to give you one level that matters more than any other this entire week, it's 0.6837. That is the abyss. A daily close below that on Wednesday, Thursday, or especially Friday changes the monthly trend from neutral to full bearish continuation. If we get a clean break on NFP Friday, the whole structure resets, and we're talking 0.6700 and beyond. I'll have the updated blueprint for you this Sunday, mapping the next weekly range. If you want to see how we got here, last week's Australian dollar to US dollar recap is live right now. Tap the end screen and loop back so you see the chain of levels that led to this 0.6899 gridlock. Then hit the bell. Sunday's next week ahead alert lands before the Monday open, and you don't want to be reacting. You want to be positioned. Hold the like button and subscribe. Every signal you send helps the algorithm bring you the levels that define your week. This week is ruled by 0.6837. The traps are set. The liquidity is waiting. Trade the plan, not the noise.